Hello, everybody. So we are just going to make a few short videos about, or two short videos about the information from chapter two and chapter three. We didn't quite finish chapter two in the first week, and I have some things at the very end that I think are important that we should discuss about the financial statements. And also chapter three, very small amount of content in there that we really need to focus on or is difficult to digest. I think most of it is something that you could probably get on a close reading. So I'm going to keep my comments pretty limited here, but wanted to share some important ideas. So going to the slideshow here with the balance sheet, this is about where we wrapped up when we were talking in class. So the balance sheet, as I mentioned in class, is presented in order of liquidity, right? We learned that in intermediate that we have our most liquid assets at the top of the balance sheet. And as we go through the asset categories, they become less and less liquid. So it tends to be that we have our current assets, then our long-term investments, our PP&E, and our intangibles. Now, this also coincides with a reliability of measurement, where the items at the top of the balance sheet are more reliably measured. So, of course, cash, right? Supremely reliably measurement of cash. There's no estimates. We have strict transactions, we have receipts. So we can very much be assured that our cash is on point. Marketable securities also have highly reliable measurements because for marketable securities, we hold these at fair value, the market value of these items, and there's an orderly market that we can check for the amounts of these. We start getting into receivables and inventories, and those tend to be fairly reliably estimated. However, there are certain things that go into those accounts that can be biased, right? For example, with accounts receivable, we have to estimate bad debt. That could be subject to managerial bias. Inventories, reliably measured, but sometimes some companies include different costs, not necessarily wrong costs or fraudulent costs in their inventories, but just costs that are unique and individualized to the industry that the company is working in. And we keep going down other. I do want to talk about other items, other current assets, other non-current assets. So these other items, they're a mixed bag. And if the company has material accounts, material transactions that it's recording within other items, it's likely that they're going to have financial statement footnotes about those, and we should investigate. Always investigate other items in this because we're not quite sure what's in there. Now, other current assets tend to be like prepaids, any sort of prepaid assets. This goes beyond just prepaid rent, prepaid insurance, like we talk about in intermediate. It can go into what we call prepaid revenue shares for internet sites. It can go into any sort of deferred tax issues that are within our other current assets. It could be a host of things. We do tend to consider these operating, though, just by default, unless we have evidence otherwise through a footnote or through further analysis. We consider the other items to be operating for the company. And we'll talk more about that when we get to the statement of cash flows. And we'll talk a lot about it in chapter four on Wednesday. When we get into the non-current assets, of course, our non-current marketable securities, a lot of those tend to be reported at fair value. A lot of them are available for sale securities. Some of them could be long-term notes receivable. Those would be very reliably estimated. When it comes to held to maturity securities, the principal is certainly reliably estimated, and that represents the bulk of the value of held to maturity securities. Yes, there is a discount or a premium based on the time value of money, and that is subject to a discount rate, which has to be estimated. But for the most part, this number is reliable. Property, plant, and equipment, if we're looking for a liquidation value, not reliable at all, right? Because remember, depreciation is not seeking a fair value for this non-current asset. It's just applying depreciation expense accumulated over time, subtracting that from the historical cost. And so that does not give us a very accurate picture at all. Other non-current assets is the same story as other current assets. We have to do a little bit further investigation. If we cannot figure out what those are, or if there are no financial statements footnotes to direct me, then we have to be very careful with those because they may not be very well estimated. And again, remember that when the designation is other, we assume that those items are operating in nature, not investing, not financing, but operating. Intangible assets, not here. Um, and where that would be for Apple, I'd have to look into their financial statement footnotes to know for sure. Might be in other non-current assets. It might be that their intangibles are just at such a low value because they are being developed in-house. We don't get to capitalize a lot of that value when we develop our own intangibles. So that is not necessarily a huge surprise that we don't have a bevy of intangible assets on Apple's balance sheet. Let's see, anything else to say about this on this slide? Just make sure that you are aware of those items. The other designation, very important to kind of look inside and see what's making that up. And other than that, really understand the liquidity prospect of the balance sheet, but also how this dovetails into how reliable those estimates are for each item. With liabilities, we're a little bit safe because most liabilities have very little discretion for reporting. I mean, we know how much we need to pay our employees, we know how much we need to pay our vendors. So, though accounts payable, um, the other accrued expenses, which is where our employee wages and employee compensation would fall, those tend to be on point. We have to have, oh, and also debt. Debt makes up a huge part of the liabilities, right? So that goes the same way as I was talking about HTM securities as an investment, right? Because an HTM security is the other side of a debt investment, right? When we're borrowing money, the majority of the account that is reported under liabilities is the principal. We know what the principal is. It's a contracted term. The only thing that has a little bit of estimation issue there is discounting the cash flows and then coming up with that discount or premium that we also apply. Make sure that when you're looking at these liabilities that you have, and this goes for everything that we do with financial statement analysis, you have to know the business model of the company. You really need to know what their segments are, what services, products they provide, where they're providing them. You need to know the scope and the nature of their operations in order to know what the important liabilities and assets are. Um, the liabilities to really be worried about are the ones that have the high reporting discretion. And that tends to center around contingencies and commitments. You'll notice that a lot of companies do not report their contingencies. And this is to the discretion of reporting a contingency. Under US GAAP, we have to establish that a contingent liability is more likely than not to occur, and the amount of the obligation, the dollar amount of the obligation has to be reliably measured. So if either of those two things doesn't pan out, we don't report the commitment or the contingency. It's very easy for us to massage facts to say, no, this doesn't fall into the threshold of being more likely than not to occur. We could also argue that we can't reliably estimate the payout. Those two things would result in a commitment not being on the balance sheet, and maybe it should, right? That's where we have to do a little investigative reporting. Maybe the company is against the lawsuit. They will never report a lawsuit on their commitments and contingencies. So you're going to have to do a little bit of research, look into some investigative reporting, maybe some popular business media to figure out what the lawsuit entails, what the buzz is around it, how likely it seems that the company might be found liable for the damages or the product recall or whatever this might be, right? So make sure that you're in tune to that and make appropriate adjustments when needed. Looking here at all the current liabilities, right? We have our high reliability accounts payable. Other current liabilities, yes, this involves wages payable. It can also start getting into like accrued sick days, things of that nature, where we do maybe promotion liabilities, where we offer certain promotional pieces that would fit into a liability. So that could be subject to some discretion. Deferred revenue could be subject to the discretion of the company's revenue recognition policy, which we'll talk about in a second. Commercial paper is just debt that's traded between companies, always very short term, highly just debt. That's just principal, right? Term debt means any sort of a structured 10-year, 20-year, 30-year bond with interest on it. This is just the term debt that's coming due and would have high reliability. The term debt that's coming due within a year or an operating cycle, whichever's longer. Um, the non-current liabilities, right? High reliability of term debt. Again, we have the principal that we're going to have to pay back being the lion's share of the amount that we see here of the $98 billion. Other non-current liabilities, just like other current liabilities, yeah, we got to look in there. We got to figure out what's driving this. Some of it might be reliable, some of it might not be so reliable. So we got to get a little bit more of an all-encompassing, not just fact-checking about what's in there, but then also compare that to the business model. Like, is there discretion over this from your accounting knowledge? So getting to the income statement. Revenues are super important, right? This is something that's projected, right? Forecasted. Cash flows are forecasted, earnings are forecasted, and this is always featured as the top line on any income statement. And again, it goes back to understanding the company's business model. Every company will have information about their revenue recognition policy that is required reading for any financial statement analysis. You need to know when they're recognizing the revenue and whether that seems appropriate for how the business model is working. Okay. Another thing to really keep an eye on for earnings manipulations is what is the relationship between revenue recognition and cash flows from operating activities? So that's going to be something we're going to talk about in the future chapters where we're looking at um, how high quality is the income statement? Does the income statement report accruals that eventually turn into cash? How long does it take for those accruals to turn into cash? So those are some of the things we'll be thinking about going forward. This is just a snapshot of Apple, right? Their income statements for the past 3 years. We have a little bit, some different presentation styles across the board with companies. They're not always going to report everything in the same way. They have freedom and flexibility within GAAP. Of course, we start at the top with our revenues from products and services. They split them up here so that we can get a better idea of what's going on in between the two that Apple is that the two ways that Apple earns revenue. And then we have the cost of sales also split between selling inventory and selling services for a total cost of sales. And that gives us our gross profit. Now, right after gross profit are our operating expenses. Oops. And then remember, when we talk about operating, we're talking about the costs of running the business. So this is intricately related to the business model that the company's working in. And tends to be the expenses that we're going to see recurring time and again. Okay. That is why operating income, after we deduct, in this case, R&D and SG&A, that's why operating income receives a lot of scrutiny in our analyses, because this is the profitability that we expect for the company to carry forward, because it is indelibly linked to the operations of the company. After operating income, we have this other income expense net. Now, companies might have three items below operating income before income taxes. This one only has one. You won't see many. This one in particular, right, has netted, for example, interest expense and interest revenue. Apple has, if we look back, oops, wrong way. Apple has, if we look back at their financial statements, in their balance sheet, they have marketable securities, both current and non-current. Those are generating interest revenue. It also has term debt, current and non-current. That's generating interest expense. And so part of this other income expense net is the offset between expenses and revenues that are interest related. Other things that can fall in this category outside of operations would be the gains and losses from selling investments, right? Um, would be any retirements of debt that resulted in gains and losses. Sometimes can be gains and losses from selling any non-current asset, so even PP&E. Um, Most companies report that as an operating expense, but some companies I've seen, and even this our text author mentions that the gains and losses from PP&E, selling PP&E, are non-operating or would be included down here beneath operating income in this other income expense net. Right? I see it more in operating than non-operating, but anyway, those are the items that are in here. Just understand that this is netting the two pieces off. So it could be difficult for you to ascertain certain financial ratios that we want to calculate in chapter 4 if they don't report separately. Um, what else do we got here? After we take off our non-operating items, we will then have our pre-tax income. And one other thing I want to say real quickly, really the non-operating items are either uh, financing accruals or financing expenses, financing revenues, or investing expenses and revenues. So we have that investment revenue or interest revenue, for example, that belongs in non-operating because it belongs to investing. We also have interest expense. Interest expense is related to financing, and so that's also not part of our operations. One other item that can be beneath operating income are non-recurring items. So those are the things, unlike operations, where we don't expect them to continue to happen time and again. We have our income, pre-tax income, or the income before provision for income taxes, and then our tax expense, which is the provision for income taxes. Then it gets us our net income and our earnings per share, right? So make sure you know the layout of the income statement, what items are put in each bucket. And really, to me, it helps to think about the statement of cash flows, operating activities, financing, and investing activities. Operating activities are all up here at the top. And then we get into investing financing activities down here on that one single line item. Okay. Obviously, these aren't cash flows, these are accruals, but just make sure that we understand that. I should say they're not strictly cash flows. There could be some cash flow, but mostly accrual. So make sure that, of course, you understand those items. Understanding that the business model is so important, especially when deciding like, is this going to be a recurring expense? Looking into, for example, if there are restructuring costs on the income statement. Those would be an operating income. They would be before that subtotal of operating income. So make sure you understand what is the nature of the restructuring? What is the company doing? What are the liabilities involved with restructuring? How much is it going to cost? Um, I think we covered everything else there. Basically, yeah, you need to get familiar with what could be in each grouping, what types of expenses are in there, and what are netted. Which ones are netted? Usually interest and expense and interest revenue. Most typically are going to be netted almost every time by most companies. Um, So let's talk a little bit about statement of cash flow. So as I mentioned, statement of cash flows breaks into three categories. We got cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. And really, cash flow from operating activities, CFO, is going to be the closest to net income. It's the closest cash proxy to net income. That's because the operating activities are the ones that will be recurring sources of cash for the company. So we expect most of our revenues and expenses to eventually materialize as cash inflows and outflows from operating activities. Now, to gum up that issue a little bit, most companies use the indirect method to prepare their statement of cash flows. And that indirect method, I hope you recall, is a reconciliation. What we're doing is taking net income from the income statement and stripping out accruals that affected net income. And how we do that is by really looking at them in two batches. There are the non transaction accruals, and those have directly affected net income without and tend to with some amount of managerial, I won't say with some, but with the potential for managerial bias. Okay, we'll talk about that in a second. Working capital accruals are the result of current assets and current liabilities shifting over time, and they can indirectly affect net income. So let's look at this Apple's statement of cash flows, right? We only are looking at the operating activities. And as I mentioned, we are doing the indirect method. Like 99.9%, I don't know if it's that high, but at least 90%, more like 95% of companies use the indirect method for proprietary costs. They don't like the direct method. It gives a little too much clear information about how the company is managing its cash and operations. So we do the indirect method usually. That's what we have to work with as analysts. We start with net income, and then from that, we're adjusting. So, for example, net income was reduced by depreciation and amortization, but in terms of developing a measure of cash flows from operating activities, that's not a cash expense. We debited depreciation expense, credited accumulated depreciation. There was no cash outflow. So, in order to take that accrual out, it affected net income, but it did not affect cash. So, we want to add that back because it reduced net income, but did not reduce cash in this period. We need to add it back, right? Yes, there was a cash outflow when we bought the item, right? When we bought the PP&E or the intangible that we're amortizing or depreciating. So there certainly was a cash flow, but it wouldn't be operating, right? It would be an investing cash flow. So we add this back. Also understand that depreciation and amortization are estimates that have the potential for bias and noise. So these are pieces that not necessarily that robust. We want to take them out. Share-based compensation expense. This is for any sort of stock option issuance that the company uses to compensate its employees. Now, when the company gives its employees stock options, we do not have a cash flow, right? We're rewarding them with something that they can buy at a later date from us. And yes, there will be some taxes involved with that and under certain stock option plans that the company might need to pay. But by and large, what we're talking about is we're accruing an expense because we issued stock options, but there is not going to be a cash outflow because of that. We want to recognize it as an expense because we are compensating employees for work they do. So it's clearly a value reducing, or I shouldn't say value reducing, but an equity reducing aspect of the company that they're giving up stock options with value to their employees. And we need to match that to the revenue that those mostly high-powered employees are providing the company for their stock options, right? So we need to recognize all that, but for the purposes of deriving state cash flow from operating activities, we just add it back because there's no cash involved. Now, the ones that are working capital accruals, this is what might have been pitched to you as the current asset, current liability rules. Now, those are going to be an indirect effect on net income. So, for example, if accounts receivable increases overall, what that tends to mean is that we've recorded credit sales, e.g., revenues, that have not yet been received as cash. So increases in accounts receivable are subtracted from. Take the flip side of a deferred liability like deferred revenue. As deferred revenue rises, that means we're getting cash payments in advance of doing the work. So as our deferred revenue rises, that is cash information that has not yet been added into our net income number. We need to add it as deferred revenue increases in order to arrive at cash flow from operating activities. Cash flow from investing. So cash flow from operations, when we do the indirect method, those aren't actually cash flows. These are adjustments to net income to get cash flow. Cash flow from investing and cash flow from financing activities do represent directly inflows and outflows from purchasing PP&E, intangibles in the case of cash flow from investing activities, or any cash flows from issuing stock, retiring stock, repurchasing stock in the case of, or issuing debt in the case of cash flows from financing activities. So just looking at some of these from Apple investing and financing activities. Notice we have, of course, the purchase of marketable securities. So we're investing in investments. Proceeds from maturities of marketable securities, right? That's selling them. Or perhaps not, because then I was about to say that's selling them. This is when you can get different words in different places. Proceeds from maturities, my apologies, not selling them. This is from them just having their due date when the person who we allowed to borrow our money by buying their investment is paying us back that money at the end, at the maturity of the investment. The next is selling it, right? Proceeds from the sale of marketable securities. Payments for the acquisition of property, plant, and equipment. So we're expanding, we're creating new buildings, buying new buildings, more equipment, right? Things we use to operate the business. Sometimes these will be called capital expenditures by a lot of companies. So make sure you know that piece of it. And payments made in connection with business acquisitions. So any sort of joint ventures, business combinations, or perhaps even acquisitions, direct acquisitions would be listed here as an investing activity. This might be equity method, this might be consolidating, I'm not sure, but that is the flavor of what's there. Um, any other investing activities I can think of? Off the top of my head that tend to be common, no, that this pretty much hits them all. For financing activities, right, there is that payment for taxes when we have a share settlement, like I was mentioning with stock options and things like that. Some plans of stock options have a tax that the business has to pay when the employee exercises their option. um, Dividend payments, right? Obviously, that's an outflow. Repurchase of common stock, another outflow. Proceeds from issuance of firm debt, of term debt, not firm debt. That's when we're issuing bonds, right? We have 10-year, 20-year bonds. So we're selling them. Issuance just means selling, right? Repaying on debt. So buying it back, maybe, um, calling it, or just it's coming due. Doesn't seem like there's a maturity of debt line here. Proceeds from or the repayments of commercial paper. Notice that in this case, this is, remember, commercial paper is that short term, very short term debt that companies tend to allow other companies to borrow. When I buy someone else's commercial paper, I'm letting them borrow money from me. They're going to pay it back. And this tends to be a sort of revolving credit line for a lot of companies that deal with commercial paper. So that is netted, the inflows and the outflows, right? Oh, and there is actually, yeah, the proceeds from the issuance of term debt net. Again, this would then be perhaps also some, I'm not exactly sure because again, would have to look at footnotes to really figure out what they mean by this because they have proceeds from the issuance of term debt and the repayments of term debt. Um, so that doesn't seem to be netting like this line does. This is proceeds from repayments of, whereas this is proceeds from, and then the second line is repayments of. So they have their long-term liabilities on two lines with the inflow and the outflow separated, whereas the commercial paper has the inflow and the outflow netted. So those are some, just some things you got to really kind of pay attention to when you're doing a thorough analysis of the company. Um, and then finally, I need to learn to swipe with two fingers, not three. So finally, we have the statement of stockholders' equity. Now, everything that affected the income statement is going to trickle into the equity, right? It's going to either move in through net income, which is going to alter retained earnings, other comprehensive income, which will affect accumulated other comprehensive income. So those are the two where the income statement flows into, right? Then we have our transactions with the owners of the company, and we issue shares to our common holders, right? That will be in the statement of stockholders' equity. Share repurchases, where we buy back shares from our common holders, that would also be present in there. And then any dividends. Pay attention to OCI. OCI is very dependent on what's making it up. Some OCI will be very transitory and will not have a severe impact on the company's financial position. Remember that available for sale securities, unrealized gains and losses and available for sale securities go into OCI. Translation of foreign currencies goes into OCI. Certain hedging, cash flow hedges go into OCI, and pension for defined benefit plans that can affect OCI. Now, the pensions tend to be amortized into net income over time. So not a lot to worry about there. It's just a place for that to sit and slowly affect net income over time. When it comes to AFS securities, especially for banks or other financial service companies, we have to be very worried about their AFS because obviously available for sale securities is huge for financial service companies. Um, Unrealized gains or losses are going to be in those particular items will be severely impacted by interest rate risk, for example. So if the company has a large gain position, then we need to be aware of the fact that, hey, if interest rates rise, then that could force it into a loss position. If interest rates rise, there might be a sell-off of AFS securities as, prior to interest rates rising. And all of a sudden, those unrealized gains would go into net income. So just remember that OCI, things aren't permanently locked in OCI. They get recycled into net income, especially when we're talking about things that are easy to sell, like securities. Now, foreign translation, the translation of foreign currencies, again, that gets a little dependent on what we're translating, right? Is the translation of foreign currency, is that predominantly about investments that we hold in other countries? Like I mean, stocks and bonds in other countries, or is that related to fixed assets that we hold in other countries. So that's something to consider there. But just, be a little bit circumspect when dealing with OCI, understanding that there can be some things that affect certain industries more than others. Um, but they tend to be pretty small overall for most companies. And this is just an example of a shareholders equity section, um, and an accumulated and the statement of comprehensive income. So with the statement of shareholders equity, we start with the beginning balance of everything, and then it just looks at its common stock. Like, what happened with common stock? Well, we issued some. Some was withheld for employee benefits. Some share-based compensation rate happened where employees exercised their stock options, which increased our common stock balance. Oops. So that's what that share-based compensation is. And here's our retained earnings. It shows everything that affected retained earnings, net income, dividends, both dividends and dividend equivalents. So um, that is obviously related to payment of our owners. Common stock that's withheld again to net share settlements of equity rewards also can affect retained earnings. Um, Repurchase of common stock. This is where we'll find a lot of companies showing their stock repurchases effects, and cumulative change in accounting principle, is just what it means. When they adopt a new accounting principle, sometimes they're allowed to bring it in through equity rather than realize it in net income. With the statement of shareholders equity, now we're into the accumulated other comprehensive income piece. So it shows the beginning balance, what the OCI gain or loss was. This, for example, right, would cause me to say, whoa, what happened? Right? We're at 42 million. I think these are in millions unless otherwise stated. $42 million gain in the first year back here to a $569 million gain. That's not extremely worrying, in terms of OCI fluctuations. This is a little much from a half a billion to an $11 billion OCI loss. What happened here? Big what? Might not be a red flag, but a big question mark here. All right. So that wraps up that slide deck. I do want to talk about one other aspect quickly. Oh, which is related to this. I wasn't wrapped up with the slide deck. So this to some degree shows the articulation of the financial statements, right? We have beginning of the year balance sheet, right here, all our accounts listed out where they started, then where they all ended up. But that balance sheet just gives me those two snapshots, right? It's the bookends. What happened in between? The financial statements give me the best ideas of what happened in between. These are my flows, right? These are stocks where it started, the stock of where we started, the stock of where we ended up, and then now we have flows between those 2 points. Cash is super important, right? Very important to creditors, very important to the company having financial flexibility and being able to exploit market niche opportunities and act on them. So the story of cash from beginning to end is reconciled by telling me how that happened, where the cash was earned, operations, investing, financing on the statement of cash flows. Owner's equity, also very important, right? This is what's left over after the company has satisfied all of its obligations. So we want to know how it grew, why it grew, how that, what stories that tells. And then a part of that shareholders' equity is given to us by the income statement. And that makes it a sort of nested financial statement, right? It's the income statement's kind of nested inside the statement of shareholders' equity, but it's such an important story, right? That it gets its own statement. Now, what I wanted to say is I wanted to talk a little bit about the increased articulation between the income statement and the balance sheet. So with this, I'm just going to do a little bit of drawing off to the side because creating any slides takes far too much time for this little bit of a exposition going on. Now, we have the balance sheet. Orient myself. And of course, it has assets, liabilities, equity, right? So our retained earnings isn't down here, assets, liabilities up here. And we have the income statement. And a very abbreviated way of talking about the income statement would be, well, we have some revenues, we have some expenses, and that gives us net income. Now, this is an issue of how interrelated these two are, where first we need to recall that revenues and expenses are simply accounting terms. So revenues are increases in net assets resulting from operations of the company due to increases in assets or reductions in liabilities. Oops, not on the page. So we're increasing net assets, A minus L. And that's a result of our company performing its operating activities for the period, selling inventory, providing services. And what happens, or the way that our net assets are increasing, is either I increased an asset or I reduced a liability. Okay. So anytime we credit a revenue, the debit has to be to the asset or to a liability, never equity. Anytime we debit an expense, the credit has to be to an asset or a liability because expenses are, of course, just the opposite. There are reductions in net assets resulting from operations of the company due to decreases in assets or increases in liabilities. So if I recognize an expense, either an asset's going to fall or a liability is going to rise, right? So when we recognize it, and it makes it so painfully obvious when I write a journal entry and I'm like, okay, I want to credit revenue. All right, well, I credit revenue, say $10, but what is this account going to be? Has to be an asset or a liability. If I put an asset in here, right, I'm increasing assets or a liability. If I put a liability in here, I'm reducing liabilities. So what I'm trying to get at here is these affect assets and liabilities. Any issues there are with the quality of certain revenues or expenses is going to show up on the balance sheet, right? Because if this expense is a problem in some way, shape, or form, it's going to create problems with the asset valuation or the liability valuation it was attached to. So these all affect in one or the other, right? But they also calculate net income, and net income, of course, gets shuttled over here, right? So it's tied into two places. The income statement really it it enters in as a subset of the statement of shareholders' equity because it affects retained earnings and AOCI, but it also affects my assets and liabilities. So we got to be really concerned about that, making sure we understand how issues of quality in one statement can affect the other statement. Okay. And if we do find some asset over here that has an issue in valuation, now, most likely, the issue in valuation isn't coming from some straight up transaction where I bought equipment for cash, right? One asset for another, or I paid off my taxes payable, right? Asset for a liability. Where the problems are probably going to crop up are those accrual components that the revenue or the expense is tied to when the asset moves up or down. So that was just the last piece of articulation that the book didn't really go into. It talks a lot about net income feeding into equity, which will change equity and have, the same issues there, but does not really get into the formation of assets and liabilities as much as I wanted it to. So that was just a little side note. Anyway, I hope that sets up some memories of intermediate, hopefully not scary ones. And if you have any issues or didn't understand something or are, having an issue in the middle of going through and figuring out some sort of a business analysis, let me know. And this is just something, that we're going to learn over time. These are not hard and fast rules. The reliability of components of assets and liabilities, we're going to learn more as we analyze more. So just trying to lay the groundwork, the big general rules of thumb, and get you thinking about what's embedded in each statement and how we have to think about that when we perform financial statement analysis.